So the next sum is going to be a little bit additionally. We have some concepts here. So it works like this. This method is when a provision for depreciation account is maintained. Okay. So under this method, the amount of depreciation to be provided in a particular year is credited to provision for depreciation account. Okay. So whenever we are going to charge depreciation, we are not going to charge it to the asset. Okay. We are going to charge it to the provision for depreciation. So this account will always be in credit. Okay. Provision for depreciation is a liability side item. Okay. It will always be a credit item. So the depreciation is being provided, and once the depreciation is provided, thereafter it is like nullified by transferring to the SOPL. So that is nullified. So if you look at both these entries, the asset is not touched at all. So without touching the asset, they keep on providing depreciation. That means at what price the asset was bought is like it is kept at the same value till the asset is sold. Okay, so till the asset is sold, the value is going to remain same, and the depreciation and the provision for depreciation alone will keep on increasing, because every year the depreciation is provided. The provision for depreciation account just keeps adding up like a reserve. Okay, slowly it keeps on adding, and whenever the sale is made, okay, whenever a sale is made, the provision for account is closed for that particular machine, and that is transferred to the asset account. Okay, that is transferred to the asset account, and from the asset account you now have three items. One is the value of the asset, two is the provision for depreciation, three is the bank value that is being like the sale value that we got, and the adjusting item would be the sale. Okay, so it's just like the depreciation alone is maintained separately. So we'll start from here. We have a problem, so we'll start from here. So this problem, if you look, George Co Limited purchased a machine on 1st January 2005 for 50,000. On 1st July 2005, further machinery was purchased for 25,000. On 1st July 2006, the machinery purchased on 1st January 2005, having become obsolete, was sold off. Okay, so they are buying one machinery and they are buying another machinery, and they are selling the first machinery. So that is the moment of the purchase and sale. Depreciation has to be charged 20% on the original cost. Okay, so it's a straight line method. Assuming that the accounts are closed every year on 31st December, you are required to prepare machinery account as well as provision for depreciation account. So you have to prepare two things. So this provision for depreciation account can also be called as accumulated depreciation account. So we'll start the problem here. So it's like accumulated depreciation or provision for depreciation. However you have it, you can have it, but we will work out with the name provision for depreciation itself. So we'll start. So on 1/1/2015, we have a bank, and the amount comes to 50,000. And next one is on 1st July in the same year, on 1st July on the same year, we are buying another machine. So we'll mark it as M1. So the second machine purchase was 25,000. So that's done. On 1st July 2006. Okay, so it's on the next year, so we don't need to worry about that year. So we have to provide depreciation. Depreciation would be, as it's purchased for the entire year, held for the entire year, so we can provide the full depreciation. So it's going to be 20%. So we have to give a date, right? That's for the first machine. So if you want, we can mark it as for, this is for M1. So we'll now give it for the machine 2. So machine 2 depreciation would be is 25,000 and it is held for only 6 months. Okay, so we got for the first year. So first year balance around we have to get. So let's get the balance. Okay, so now if you look at here, usually this is how we set accounts. Okay, this is how we usually set accounts, but we should not set accounts like this for when we have a provision for depreciation. Okay, we cannot do this. So what we simply do is we have to take out these depreciations. Okay, we have to take out these depreciations and show these depreciations in the provision account only. Okay, we can show it in the provision account only. We should not show in this account, right? So if you look at here, the asset value, okay, the asset value will always be held at the original value only. Okay, so it is 7,500. It is 7,500 here. So it will be maintained at the same value. So the closing value would be the same 75,000. So it is always at 75,000, right? So the machine value has to be kept at the original and the depreciation alone has to be provided separately. Okay, so now we have to tally this side. So we have balance CF. So that comes to 12,500. Okay, so this value would be on the closing. So we have like two numbers we have got. So now we have to start with the next one. So we have to take this value and the opening date would be 2006, sorry, 2016 to okay. So we'll start from the fresh year, but we'll also open the account for this one. Okay, we have to open account for this also. So as we have two balance CF here, okay, we have to bring down, we have to bring it down. Okay, so machine side we have brought down. On the provision side around we have to bring it down. So just wait. Okay. Right. So on this side it was there, and now we have like brought forward it. So we can start working now. So on, if you see, the machine will have a debit side amount. Okay, the machine will have a debit side amount, and the provision for depreciation will have a credit side amount. Okay, so we'll start. So now only we are going to start the sale. On 1st July 2006, the machinery purchased on 1st January 2005, having become obsolete, was sold for 20,000. So there's only two machines are there. One machine we are going to sell off. Okay, so for selling it off, we are selling it only on 1st July. So we have a lot of time. So we have to provide depreciation for actually for that. So on 1/7/16, we have to provide depreciation on the first machine, right? And we have to provide only for 6 months. Okay, so that comes to 5,000 rupees. And for machinery depreciation, for machinery 2, it's held for the full year. So full year depreciation has to be provided. So we can remove the 6/12 there. So thereby we have provided depreciation for both the machines, right? So we have provided depreciation for both the machines. Now, as the machines are being sold, okay, so we'll also put the balancing figure number. Okay, of course it has to be balanced. Okay, we don't need to balance it now. We'll just have the have it as a placeholder. Don't need to balance it now. Okay, we'll start with the machine. As the machine is sold, okay, on 1/7, okay, this is a sale date, so it's going to be a buy, and we have to make the sale here. Okay, we have to make the sale here. Sale value is 20,000. Okay, and next we have to transfer the depreciation. So to transfer the depreciation, we have to transfer it from this point. We have to transfer it from here. So to transfer, we have to transfer it from the accumulated depreciation or provision for depreciation. From there we have to transfer. So the entry would be 2. From here you have to transfer to the asset side, to the machine. Whatever depreciation is like available for this machine, that is this 10,000 and this 15,000. Okay, so and this 5,000, so both has to be transferred. So it goes to machinery 1. Okay, it goes to machine account. So machine account is here. So by By provision for depreciation, we don't need to put it fully. Okay, that comes to 15,000. And any profit or loss, okay, any profit or loss again would be here. So there would be a profit or loss, we'll check. See, so how do we know that? The asset value was 50,000, okay, and the depreciation is 15,000. So the asset is now worth how much? 50,000. So we'll, if you want, we can take this small calculation here. From here we can take that and we can show you. So you can see here, machine worth is 15,000, 50,000. The depreciation on it is 15,000. So its current worth is 35,000. This machine was sold for 20,000. Okay. So there would be a loss on sale of asset of 15,000. So here it is going to be SOPL. Okay, which is a loss. Okay, loss on sale. So you have to put 15,000. So if you see here, now how much of the asset value is getting reduced? 20 plus 15 plus 15. 50,000 is reduced. So so that is the value of the machine here, right? That is the value of machine here. So if you put it here, I will put a separate color if you want. We'll put it as green. No, we can put green, blue. Okay, we'll put it as violet. Okay, look at here. From here, okay, the value stretches and it adds up to these numbers, right? Hope you got it. The value okay, hope you got it. See, okay, the value of 50,000 here, okay, would be equal to the value of the asset which has been taken out. Okay, so if you do this, okay, if you do this, what would be your closing balance? Okay, your closing balance would actually be this number. Okay, so we have to close it. That's a problem. Okay, see, the total value would be, has to be 75, but what would be the closing? The balancing figure here, okay, the balancing figure here would be only 25,000. Okay, so that is actually the machine 2's worth. Machine 2 worth is 25,000. So that alone would be kept here. Okay, and we'll go to the accumulated depreciation side. In accumulated depreciation side, we have not closed. Okay, so totally we have how much of depreciation we have, like totally 22,500, but 15,000 has been transferred. Okay, so 22,500 minus 15,000 that has been transferred, so the balance is 7,500. See, this is a depreciation we provided for machine 2 alone. So machine 2 alone, 2,500 plus okay, plus 5,000. So both these numbers added together will give you the closing value. Okay, so if you want, see, we can finish with 2016 because that is what they have asked. Okay, we don't need to do for 2017. 16 is what the only year they wanted. So machine account is 25,000, that is a machine 2. Provision account is 7,500, which is a depreciation on machine 2 alone. Okay, so hope you got a good idea here. So be very careful whenever you are like selling a machine. okay, the total value of the amount which we got, the depreciation on it, and the sale or profit, all these amounts should tally with the bank account. Okay, the purchase price, it should match with the purchase price. Okay, so that's about this problem. We'll move on to the next one.